Joining us now is Baird analyst David George and CFRA Director of Equity Research, Ken Leon. Good morning to you both. David, what were we looking for here? I mean, we knew it was going to be some sort of messy stuff in there with the FDIC charges and the rest of it. But on credit quality, on net interest, and I guess on capital markets activity, what did we learn today?
Yeah, and good morning, Mike. Thanks for having me. So from my perspective, and we talked about this on Monday when we downgraded Wells Fargo as well as a couple other stocks, the bar, Mike, going into this earnings season was the highest really since last January. Obviously, a lot has happened in the banking industry since that point in time. And numbers broadly were fine. Net interest income trends were largely in line. Credit quality trends were encouraging, as were fees and expenses. And the forward outlooks on net interest income were maybe a little bit of soft relative to expectations, but a little bit of profit taking isn't particularly surprising. And I would characterize today's numbers as pretty solid across the board.
Ken, we have the market in a familiar posture, which is buying J.P. Morgan and kind of fading the rest, at least in the very immediate reaction. It seems like it's the one that has obviously distinguished itself across the board. Is it still the right approach for an investor to essentially, migrate just toward quality within the sector, or do you think there are opportunities elsewhere?
Well, the bank stocks are pretty quiet today, but that's after a really strong fourth quarter. J.P. Morgan, Chase, I think, is best in breed quality. And there's a debate of the analysts whether to go with turnaround transformation stories like Citi or stay with J.P. Morgan, which we like and have a buy. Again, today's message is really we can take the R word for recession off the table. And if we do see moderate loan growth, that will benefit not only fee service income, but also net interest income. Overall, investment banking is really set up for a very good year after hitting the trough last year. There's an enormous amount of activity that wants to come to the market, particularly for private equity firms. And overall, we also like to worry about credit risk, a little bit of an uptake on credit cards, but commercial real estate seems more manageable for the larger banks versus some of the regionals or smaller banks.
Ken, to that point, next week, as we get further into financials, when does the conversation about investment banking move beyond green shoots? Because we've been leaning on that headline for a while.
That's right. And I think what we're beginning to see is corporates being conservative, in the early part of the year as it relates to capital investment, as they kind of figure out where their rates and cost of capital is going to be. But we are beginning to see activity in debt underwriting and equity underwriting. And I would really underscore the private equity firms were not able to release or monetize sizable businesses that they want to see an exit, whether it be through IPOs or M&A. So this is going to be, I think, the stronger part, maybe in Q2. But overall, it's not going to be V-shaped. But we do see, and you'll hear from Morgan Stanley and Goldman Sachs next week, a more optimistic view about 2024.